So, hi everyone. First of all, I just want to say thanks for joining the first in a series of webinars focused on IP valuation. I appreciate it's a really busy time for a lot of people at the moment, coming up to the financial year end, but it may also be a crucial time to consider your capital requirements and raising investment. So I thought this is an area we can help provide some practical guidance in. And some of you may also be familiar with our previous webinars that were hosted by our corporate recovery team where they were looking at IP assets specifically in insolvency. However, we'd only be focusing on IP valuation for solvent businesses. So just to quickly introduce ourselves, my name is Saj and I'm the Valuations Manager here at Metis, and I've also got my colleague Kieran here, who is one of the analysts in the valuation team.
Hey guys.
So we typically handle all the valuation assignments at the moment, and that involves engaging with clients and conducting an information discovery process, along with all the analysis work and the report writing that goes into it. It may sound simple on the surface, but I can assure you it certainly has its challenges, which is maybe why it's not quite a common practice at the moment. So just a little bit about Metis Partners, and for those who aren't all that familiar, we do offer various IP-related services. That's what we specialise in, and that ranges from IP strategy and advisory services, such as due diligence, to valuing and selling IP assets for our clients, and that can be both in insolvency and also on a going concern basis. We are based in sunny Glasgow, as well as having a presence down south in London and across the pond in the west coast of the US. And we also have a very diverse team here. I think it's like over 10 nationalities, and we have varying backgrounds from mainly kind of accountants and lawyers. Okay, so what we'll be discussing today. So first of all, we'd just like to start with a quick poll to test some of our viewers and just try to gauge the kind of general consensus of where IP value lies. And after that, we'll be talking about who would typically need an IP valuation and the kind of types of clients we tend to have. And then we'll be looking more in depth at equity finance and how investment-based valuations, as we call it, of IP can transform funding options for many companies. And we'll also go through a case study just to show you how this can be put into practice. And then my colleague Kieran will focus on debt finance in particular, looking at how lenders may now securitise against IP and just detail on how this can be done. So we'll just start the poll now. Okay, so we're just asking here, which asset do you think is kind of most preferred by lenders to take security against? So what we're looking at here is not only what asset are they comfortable with, but also we might be looking at what asset may be more valuable, or what asset you feel is easily kind of identified and protected, and as I said, kind of taking security against. So how do we think what you think that might be? And it'll be interesting to kind of gauge what most viewers feel is the kind of key asset in this area, and then obviously we'll give you a bit of insight of what we've kind of found actually working in the field.
Well, they're actually doing pretty well there, actually.
Just give us a few seconds.
Very nice. These guys know their stuff. Okay.
Okay, so actually most of you picked out patents as the key asset there, which we'll be happy to know is actually what we also find is this kind of probably the most important asset that I think lenders and banks tend to look at. So just giving a bit more information about that. So the reason we say patents are kind of number one in this list here is that they are a legal right, so it's very easy to kind of identify and show how it's separable and transferable, and obviously a lot of the time it underpins the actual competitive advantage of the business. Closer behind that you've got software as well. Again, that can be highly valuable, but as opposed to patents, it can be quite difficult to secure. And as we said, kind of separate from the business. Another kind of key asset is trade secrets. Again, that can be really valuable if they're properly documented and actually kept secret. and a lot of time they are used kind of in conjunction with other assets and kind of packaged with patents specifically. And then lastly, we've got brand here. Again, this can be one of the kind of key assets for a number of companies. Again, only if it's fully registered and protected accordingly, which sometimes isn't always the case. So thanks for taking part in that poll, guys. Hopefully that was useful. Okay, so moving on to give some examples of common IP assets. So we've split these up between kind of formal and informal IP, as it's known. And as you can see, formal IP generally relates to kind of registered rights. As I mentioned, there are things like patents and trademarks, which a lot of you may be familiar with if you've registered them yourself for your kind of own companies. Informal IP are some of the kind of assets which are commonly overlooked, we feel, or they may be kind of harder to take security over. But for many companies, this can be, their most valuable asset. So think of, for example, Coca-Cola's recipe as a trade secret. You've got Apple's kind of main brand, which is something they regularly capitalise on. Or, for example, take Google, you've got their kind of software algorithm. So these are all examples of what would be informal IP, but as you can see, that's probably one of the kind of key assets. So another way to put it simply, or another way to kind of think about it, if you're looking at your own business, is IP can basically be any kind of information or data that you might be worried about one of your members of staff kind of putting onto a USB stick and walking into a competitor with. So that can be in the form of any critical databases or kind of customer lists with pricing information, that kind of information that you don't want any of your competitors knowing about. Okay, so when it comes to carrying out an IP valuation, these are some of the kind of typical clients that we come across. But to be honest, it could really be applied easily to any type of business. So you've got companies who can historically have a weak balance sheet, and that can be due to having a lack of tangible assets on there, but they may actually have a wealth of IP that hasn't been identified or valued, or shows up on the actual balance sheet itself. So you've also then got companies with a kind of strong brand that could be leveraged as it hasn't been in the past, or you can have startups that are looking for that really crucial kind of cash injection, or you may have a pre-revenue business in need of investment so they can continue to develop and eventually commercialize their kind of IP and product. And then software companies are another real kind of common type of company where IP is the main and sometimes the only asset they may have. And a lot of the time, 100% of the revenue is actually generated purely through their IP, and that can create quite a kind of challenge in that sense. So why get an IP valuation? Well, there's multiple reasons why a company may pursue an IP valuation. First of all, this can be for compliance purposes, such as meeting accounting requirements. So following an acquisition, you may have to perform something known as a purchase price allocation. You've also got reasons around kind of M&A and to support, say, a negotiation for a purchase price of IP or like a bundle of assets. You may also need one for an asset transfer, where IP has been transferred either between group companies, or you may be setting up something known as an IP co. And these are all areas which we'll kind of cover in more detail later in the series. But if you're interested in the meantime, there's lots of information on our website, or feel free to get in touch with us as well. But as I mentioned, today we'll only be focusing on the last topic here, which is raising finance, and that's both from the perspective of equity and debt finance, and we'll talk about how this can be applicable to a mixture of businesses. So, starting with equity financing, so this is where we would generally perform what's called an investment-based valuation, and that's to highlight the potential of the business and its IP. A key advantage of valuing IP here, which is something we're always trying to get across to our clients, is around bridging the gap between the book value and the market value. And that's where a company, say for example, they're looking for an investment of multiple millions, but actually on paper the value of their intangibles doesn't add up to a significant amount. So this is where IP can prove to be the difference, and it can really help show the missing link in the kind of contrasting valuations of the company. And I think the next point here kind of further backs that up, where it's known that almost 80% of a company's value is made up of intangibles nowadays. And that's something that's been taken from research from the World Intellectual Property Office, and also reports by the likes of firms like Ernst& Young, who have had to really adapt to the growing importance of IP. And we can also see here the vast amount recently being invested in IP as well. So again, it's been highlighted by research carried out by the UK IPO, and they estimated around 133 billion has been invested in IP in 2014. So I think that kind of speaks for itself. But the key thing here that I think is important is that a lot of companies, especially SMEs, have limited experience in working with IP or realizing value. And that can make it appear that IP isn't actually a critical asset that's underpinning revenue, which a lot of the time we found in our experience that that's not the case. So, as with that, any asset, well, what do investors want to know? They want to know, first of all, how does it underpin revenue, or how is it fundamental to a product or service? And they also want to know, in the context of the overall market, what's unique about the IP? Why should they invest in this business as opposed to a similar competitor? And they're also interested in the quality of the asset. So, say you're looking at a brand, for example, they may want to know what the exposure is or attraction. Has it won any awards? Is there kind of overwhelming positive coverage? Those are some of the kind of key areas that we would kind of look at, and it's something that investors would be really interested in. They also want to know, is the company continuing to invest in development? Are they, continuing to update and improve their products and their product pipeline? And the last point here is they want to know, what's the demand and the market potential, and they want to understand, is the IP itself scalable, and how is that going to underpin the commercialization kind of going forward for the company. Okay, so just to give a bit of practical insight, I'm just going to run through a brief case study of an actual kind of previous valuation we worked on, and it was a really interesting case, mainly due to the kind of area that they were working in. It was a completely new kind of field, and it was a really interesting product. And what I think was a kind of great example of what can be achieved by valuing your IP before you actually seek an investment. So the company we're looking at here, they were essentially pre-revenue. They were expecting really high revenue growth in line with the market predictions, given that it was a very new market that wasn't quite established. What the company itself done is they focused on virtual reality based software, and they were really looking to capitalise on the emergence of this completely new market and new technology. So given that the company was focused on creating software and developing technology, there were very little fixed assets actually on the balance sheet. So our job here was really to highlight the value that had been created in the form of IP, so that could be kind of communicated to investors. So what was our approach? Well, first of all, we had to pinpoint the kind of critical assets that were expected to generate revenue, but also had a competitive edge, and that's what allows the company to offer something which was ahead of competitors, and was an established barrier to entry. So the main asset, as I mentioned, was clearly the software, but that alone wouldn't provide all of these benefits above that I just mentioned. So we also identified a combination of trade secrets, databases, and organisational knowledge as well, all relating to key kind of internal processes, and that really underpinned how the overall system operated, and that was the kind of the critical area there. So what we done, following a robust process, where the IP had been identified and linked to revenue generation, we then rated each asset in terms of quality, looking at kind of key value indicators, before applying what's known as an income approach to the valuation. So this also entails looking for things like comparable license agreements from previous transactions, and from that we can establish a fair royalty rate for the assets we're valuing, keeping in mind it's in the context of the overall valuation. So the important part here is about detailing the full process to ensure transparency and give the investors confidence that a sensible approach and methodology has been applied. And importantly, it provides a kind of form of diligence as well on the IP for the investors by detailing key characteristics and factors of quality. So, for example, come back to the brand, you may comment on the fact that the trademark behind the brand isn't registered, and again, that's the type of information investors would want to know and should kind of be paying attention to before making any investments. So, outcome. So the result was an IP valuation of around about 8 million, which might sound relatively substantial for a pre-revenue company, but that was backed up by the sheer number of years that they've been developing and got their technology to quite an advanced stage. Also, the protection measures that they put in place to capture and secure the IP that had been created. And lastly, the way in which the company was ready and poised within the market to really commercialise and fully exploit its IP. And what that valuation done, it greatly softened that hard sell to the investors where they were looking for millions of investment but didn't actually have the balance sheet or the physical assets or really the financial promise to be able to kind of back this up. And I think that meant that it was a really great result for the client as they were actually able to achieve their kind of desired funding through using that valuation during things like their investor presentation and pitches and during their kind of fundraising efforts. So I think that's a really good example of what can really be done in these types of companies where IP is the key asset and they need to be able to portray that to their investors. So I'll just hand over to Kieran now, who will be taking you through IP-backed finance.
Yeah, thank you, Saj. And again, welcome everyone. Thank you very much for joining us. One of the reasons we decided to talk about IP-backed finance was because fundraising is a large priority for a lot of our clients. And we spend a lot of time and a lot of effort in supporting our clients through their fundraising activities. And what we've noticed is that there's a growing prominence and importance about of IP-backed finance, particularly for SMEs. And the reason this is the case is largely because of the numbers involved. So numerically, 99% of all UK businesses are SMEs. And a lot of these SMEs, they're high growth businesses. They're very innovative, and as I said before, it's not uncommon for these type of businesses to have 80% of their value taken up by purely their IP. And again, with these businesses, a lot of them are asset rich but cash poor, and in sorely need of funding. But the most valuable asset that they have to offer for collateral is their IP. And so then it follows that there's quite a lot of demand for IP-backed finance at the moment, and equally there's a lot of demand and a lot of opportunity for lenders as well in this area. So for IP-backed finance and for using your IP as collateral, there's actually a lot of benefits to come for this. So in some circumstances, finance can be based purely on the strength and the quality of a business's IP, and this is opposed to being based upon the financial position of the borrower. And this is particularly the case when the IP can be adequately secured and when it can be ring-fenced in a separate entity. Particularly like an IP co. And this is really good news for SMEs, particularly those which have a limited track record, they've only been going or revenue generating for 2 to 3 years. Because it means the finance secured is based on the strength of their IP as opposed to the credit worthiness of the underlying business. So also, another advantage of using IP as collateral is it can actually improve the lending conditions. So even if finance is not or is unable to be secured exclusively on the IP, just having the addition of the IP as a form of collateral can, say, increase the amount or quantity of the loan. It can lower interest rates and it can lead to less restrictive covenants for the loan as well. So what we're seeing is there's a lot of innovation in this area. There's a lot of kind of asset-based lenders trying to get into the sphere of IP-backed finance, and so there's quite a lot of different forms of IP-backed finance, and actually quite a lot of them mirror the types of products that are available for physical and intangible assets. So we've got IP-backed loans where the IP or where the debt is directly secured by the IP. We've got the sale and leaseback model. We've got pension-led finance, and we've got IP-backed securitization. Most of those types of finance are available for SMEs, although when you look at when you look at IP-backed securitization, this is really only for large corporates. So we've done quite a lot of work in IP-backed finance, and we've helped our clients raise millions in finance. And what you'll see in this slide here is just a number of the different companies that we've worked for, with the amount of finance that was secured just below. So in our experience of doing kind of IP valuations and doing due diligence for IP-backed finance, we've really kind of grown to understand the needs of the lenders and the factors and the criteria that are considered in determining the lending decision. So we've grown to understand what it is that lenders want and what they look for when it comes to IP-backed finance. So the first thing is that lenders want to understand the value of the underlying collateral. This is really important, but it's more than just an IP valuation. Transparency is really important here because there's an information gap between the lenders and between the underlying businesses, because lenders don't always have the expertise to adequately assess the value of the IP. And what we've found is a lot of companies actually struggle to communicate the value of their IP to the lenders. And what's important for the lenders to know is the quality and the strength of the intangible assets and their relationship to the company's cash flows. So the first point there is in relation to the business being in a going concern, but in the worst case scenario, we're coming on to point 2 here, is that lenders really want to know that in distress scenarios that they have confidence in the recoverable value of the IP. They want to know that in distress scenarios, the IP can be disposed separately from the business, and more importantly, that the IP will actually hold its value in distress scenarios. And this point moves on quite nicely to the point 3, and that lenders it's really important for lenders to know and to have confidence that there's a clear market demand for the IP and for the collateral, as well as having confidence that there's a secondary market for the IP. And this is important because part of the credit risk of IP-backed finance is determined on the basis of the liquidity of the underlying collateral. So that is, how fast can these assets be disposed, and is there a secondary market, and who are the potential buyers of these assets? So another point that lenders really want to know is they want to know whether or not the collateral is protected, is it secured, and is it transferable? Due to the nature of IP and intangible assets, like I mentioned before, it's certainly possible that someone could stick a memory card into a laptop and download the software and walk out the door. So lenders really need assurances that this sort of situation cannot happen, and they need to know that the IP is secured and protected and can be separated from the business and transferred out and disposed of. So what I'm going to go through now is just a quick case study of a lending-based IP valuation that we did, and this is a really interesting case study because it actually highlights what can be accomplished if the IP is properly considered and is correctly leveraged. So a bit of background about this company. It was a well-known business, and it was a retail business, and they sold musical instruments. So the brand had a distinguished heritage. It had been in the market and operating for over 50 years. Although the business had previously been in administration, and to cut costs, they actually had to outsource its manufacturing to Asia. So when Met's partners got involved in this job, the business was already heavily indebted. It owed £1 million to its bank from a previous administration, and it also had a lot of short-term liabilities on its balance sheet as well that the company had drawn down for working capital. So we got involved because the business came into financial difficulties and it needed further working capital just to unlock its order book. So it had a backlog of orders, but the business couldn't actually afford to pay the final installments to its manufacturer in order to release the product and the stock from Asia. And the bank wouldn't lend it any more capital. And then there was a fear of another administration, so Meta's partners was instructed to sort of assess the situation and offer any potential solutions. So part of our solution, or part of our method in this was to do some due diligence. And what we found as part of our market research is that we'd identified previous M&As in the sector where the brand was actually a deciding factor in the acquisition, and where the brand featured quite prominently within the sale of a business. And we also established that there was a clear and sustainable market demand for the company's products. And further to our analysis, we also identified that the company's brand was actually the most valuable piece of IP, and we valued it 250,000. And our solution in this case to help the business was actually very, very simple and very effective. And what it was just to transfer the IP and the debt off of the balance sheet of the trading company and into a separate entity, which was the IP co. And the structure was where the IP co would license back use of the brand to the trading company in exchange for monthly royalty payments. So the outcome of this was that everyone accepted the new structure and everyone was incredibly happy. So the company was happy to remove the debt away from its balance sheet and have that transferred back into the IP co. And the bank was incredibly happy because it was able to secure its £1 million debt against the brand as collateral, but also the royalty revenues that were received by the IP co were actually secured by the bank and used to satisfy its debt obligation. So in this scenario, the bank was able to clear its debt, and actually because the trading company was able to remove the debt from its balance sheet, it was actually able to refinance with another lender, and it was able, and the extra working capital enabled it, to pay the final installments, get its stock released, and continue trading. So this was a really good example of IP-backed finance and how IP can help lenders, because the business went from in financial stress to profitable trading within a couple of years. So that's that for IP-backed finance. So one thing, Sajid and I just wanted to kind of bring over to you guys was 5 key points, and there's something that, if there was one thing we wanted you to remember, it was these 5 key issues here. And the first was that you should never discount the value of your formal and your informal IP. So the formal IP might be really valuable because you've got your registered trademarks and your patents, and everyone knows about these, but you really shouldn't sort of miss out the informal IP. So that could be your trade secrets or databases or customer lists or even software. These can be highly valuable as well, and particularly in relation to software and trade secrets, and investors think these are highly valuable, and they can also be securitized for loans as well by banks. So the second takeaway is that understanding and communicating your IP to investors can help raise your business valuation, and that goes back to what Saj was saying about the gap between your net book value and your market value. If you can understand your IP and communicate it to investors, you can increase your valuation. Third takeaway from this is that investors want to know the IP is well protected, they want to know it's robust, and it actually underpins the scalability and then the revenue growth of the business. Another key takeaway is that in the right circumstances, lenders can find IP just as valuable, if not more valuable, than physical assets. And the last key takeaway here is that lenders really want to know that they can take security and control of the IP assets, and they need to have confidence that a secondary market exists for the IP assets. Okay, guys, that's the end of our webinar. Really appreciate all of you joining us, because I know for myself I really find IP-backed finance quite fascinating. But if you have any more issues or any queries, feel free to come contact us or send us an email or pick up the phone. The last thing we wanted to cover with you is our future potential kind of webinar topics. So at the moment, for future webinar topics, we've got 3, and we thought we would put it to you and find out what it is you want us to talk about. So the first webinar title is the importance and the intricacies of royalty rates. So royalty rates are really, really important when it comes to kind of licensing out your IP. And it's also really important for things like joint ventures. If you're going to, move your IP into a joint venture, you want to know, how much your profit share should be. Second title is identifying the hidden IP assets in your business. This webinar series will be all about sort of paying attention to assets that are usually kind of overlooked and usually undervalued, and how you can identify these and actually leverage these in your business. And the last title is just the value of IP codes and the benefits these can have to your business. So these are the 3 webinars we're thinking of doing in the future. And instead of us deciding, we thought we would give it to you and let you choose. Okay, so you guys are still voting. We'll give you a wee moment there.
Just adding, if you did have any questions over the topics we've discussed today, or you want any more advice or guidance, please feel free to get in touch, either email myself or Kieran, and we'll be happy to get back to you with any queries you have. So yeah, just thanks again for joining, and hope to see you again at some point.
Yeah, and we've got the results of your poll, and we will be working away on the webinar for identifying the hidden IP assets of your business.
It was close.
It was very close, actually. It was very close. Okay. Right. Again, guys, thank you very much for your time, and thanks for joining us, and I hope you guys have an awesome weekend.